Welcome to the deep dive. Today we're digging into Estée Lauder Companies, ELC, and their fiscal 2026 first quarter results.
Yeah, and it's quite the story.
It really is. I mean, this wasn't just a small shift. It felt more like, well, a screeching U-turn.
Yep.
They reported what was it? A steep 13% drop in organic net sales just last quarter, but Q1 totally flipped it, delivered 3% organic net sales growth. So our mission today really is to unpack how they pulled that off. What were the operational levers behind this turnaround? They're crediting it all to their Beauty Reimagined strategy.
And that sequential momentum, you just can't ignore it. Going from that kind of contraction to growth in, well, basically 3 months. That points to some pretty swift strategic moves.
Definitely.
The engine behind it all seems pretty clear, though. It's that big internal restructuring they've got going on, the profit recovery and growth plan. PRGP, they call it.
Okay, PRGP. Let's break down the shift then. So the top line, reported net sales were up 4%, hitting $3.5 billion. But the number that really jumped out, for me at least, was the profitability leap.
Yeah, that initial operating margin number, it looks, well, sensational, doesn't it? Adjusted operating margin expanded by a massive 300 basis points.
It's a huge jump.
Up to 7.3% from 4.3% the year before. But, you know, we absolutely have to put that in context.
Absolutely. You can't just look at that 300-point jump and, cheer without seeing the big asterisk next to it.
Exactly.
The prior year included that huge $159 million charge, remember that, related to the Talcum litigation settlement.
Precisely. So that charge really dragged last year's margin down artificially.
So while the 300 basis point leap looks amazing on paper, it's maybe a bit misleading.
It is, somewhat. The real story, the operational win, I think, is actually in the adjusted gross margin. That expanded, too, by 60 basis points, up to 73.3%.
Yeah, 60 basis points.
And that expansion, that's purely down to hard-earned efficiency. It's coming straight from those PRGP initiatives you mentioned.
Right. So that 60-point gain, that feels more like a measure of actual internal control. What exactly did PRGP change that boosted gross margins so quickly? What were they doing?
Well, think about optimizing, like, the whole supply chain, really.
Okay.
The report mentions net benefits from key PRGP actions. Things like operational efficiencies, getting tougher on procurement, a more competitive approach.
Makes sense.
Also, cutting back on promotions, which is significant. And, critically, a big reduction in charges they were taking for excess and obsolete inventory. So they're managing their stock and they're spending much more tightly.
Yeah, that sounds like a pretty painful overhaul, though, and it really is. Just to give you some context on the scale here.
It's massive.
ELC expects this whole restructuring, when it's done, to bring in annual gross benefits between $800 million and $1.0 billion. That's before taxes.
Wow.
And the human cost? Well, it involves cutting, net, an estimated 5,800 to 7,000 jobs globally. That's like 9% to 11% of their entire workforce.
And that kind of, well, drastic efficiency measure, that's exactly what pays for the next part of the strategy, right? The aggressive investments.
Right.
They're essentially taking money saved on the operational back end. And pushing it straight towards the front ends, the consumer-facing side, to try and accelerate that growth again.
Okay, so where is that capital going? Under this Beauty Reimagined plan, they talked about 5 priorities, things like innovation, boosting consumer investment. But the real strategic shift seems to be what they're calling next-gen coverage. What does that actually mean? Like, where are they trying to meet the consumer now?
It really means they're consciously shifting resources away from, their traditional base in legacy department stores.
Which have been struggling.
Exactly. And leaning much harder into specialty retail and digital commerce, basically where the younger shoppers are.
Okay.
So next-gen coverage is all about speed and expanding into new strategic channels. And the big ones are, well, Amazon social commerce, particularly TikTok Shop.
The Amazon push definitely looks global. You saw new storefronts opening in Mexico Clinique, The Ordinary, Estée Lauder there.
Yeah.
Then The Ordinary launched in the UK, plus other launches in Canada and Japan. It seems like they're trying to standardize what works on Amazon and just scale it everywhere.
For sure. But the really, let's say, aggressive move is how they're jumping into social commerce, like the speed of it.
TikTok Shop, you mean?
Yeah. Launching Clinique, MAC, Dr. Jart Plus on TikTok Shop in the U.S., The Ordinary in Malaysia and Singapore. And they're seeing quick wins, too. MAC actually won a TikTok Shop award, top brand campaign for 2025 in personal care.
Really? Already?
Yeah. That's like instant validation that this strategy to be more relevant, well, It's working or starting to work.
Because that covers the digital speed, but the physical side, the omnichannel strategy, that's getting a huge shakeup too. I mean, MAC going into Sephora.
That, I think, is maybe the most telling retail pivot of all.
It feels big.
MAC is entering select U.S. Sephora stores, Sephora Online, and Sephora at Kohl's. That starts fiscal Q3 2026. And they're explicit about why.
Which it is.
To connect MAC with younger consumers, to accelerate the brand's turnaround in the U.S. It's basically admitting that specialty multi-brand retailers like Sephora are now the main gateway for that demographic, not department stores anymore.
Okay, but doing all this Amazon, TikTok, Sephora partnerships, that must require some serious back-end agility, right? What are they doing about their digital infrastructure to handle all this complexity? I saw Shopify mentioned. Is that the plan?
That seems to be it, yeah. The strategic partnership with Shopify looks like the core of their digital infrastructure overhaul.
Okay.
They basically need to modernize and crucially scale their direct-to-consumer business globally. Get away from what sounds like a messy legacy tech setup.
Right.
The goal seems to be a single global platform that can scale up and deliver that, best-in-class omni-channel experience everywhere, connecting the online shops with the physical stores smoothly.
Okay, let's switch gears a bit. Geography. Because this return to growth, it wasn't the same everywhere, was it? Where was the main engine? What really powered this rebound?
Mainland China. That was definitely the primary driver.
Okay.
Their retail sales there grew double digits,
Yeah.
which was way ahead of the overall prestige beauty market in China that was only up high single digits.
So they're outperforming the market.
Significantly.
Yeah.
And gaining share in prestige beauty there, too. They mentioned it's the 5th time they've gained share in the last 6 quarters.
Wow.
And if you want an example of how their luxury focus is working there, Le Labo, the fragrance brand, nearly triple-digit growth in China.
Triple-digit. Incredible. Okay, so China's strong.
Yeah.
But were there other growth spots to show some diversification?
Yeah, they did emphasize that. They saw high single-digit growth overall in what they call priority emerging markets.
Right.
And that was led by double-digit growth in specific countries like India, Mexico, and Turkey. So, yeah, the growth story is broadening out a bit beyond just the giant markets.
Good to see. What about travel retail? That's been such a drag for them for a while now.
Travel retail did bounce back and grow, yeah. But we have to frame that one carefully, too.
Guess so.
It was growing off a very favorable comparison, like compared to a really low point the year before.
Okay, so easy comps.
Pretty much.
Yeah.
That said, specific brands like La Mer and Estée Lauder did well in Asia travel retail, and they are actively trying to fuel that recovery. Expanding distribution, new activations, opening new doors.
Yeah.
They mentioned France travel retail with duty-free Americas as an example.
Got it. So China firing on all cylinders, emerging markets contributing, travel retail recovering off a low base. Where's the weak spot then? Where are they still feeling the pressure?
The main headwind is still the Americas region. That actually declined 2% organically.
Still declining. Why?
Primarily, it seems, ongoing structural issues in department stores.
Right.
Including store closures linked to that retailer bankruptcy.
Right.
And also, they mentioned still having elevated inventory levels for some brands that kind of hung around through the quarter. So, yeah, the global strategy is moving, but the domestic retail problems, those are still the biggest hurdle.
Okay, let's quickly touch on the product categories. We know luxury brands seem to be winning, but which category was the overall MVP this quarter?
Oh, hands down, fragrance. That was a star performer.
Okay.
Achieved 13% organic net sales growth. And that was driven almost entirely by their high-end luxury portfolio, Lubbo, Tom Ford, Jo Malone London.
Le Labo again. It really feels like that brand is carrying a lot of weight for them. Is that just brand heat, or are they actively pouring resources into these luxury fragrance names?
They're definitely investing. I mean, Le Labo's growth came from its hero scents, Another 13, Santal 33, plus that Tokyo City exclusive, Gaiac 10 was apparently a hit. But looking forward, they're also opening a new fragrance atelier in Paris. And the interesting part is they plan to use tech and AI there to help craft the next generation of scents, supposedly faster.
Interesting. AI in fragrance creation. Okay, so fragrance is the growth engine. What about skincare? That's usually the biggest category, right? It only grew 3%. Why just stabilizing?
Yeah, skincare was definitely the stabilizer this quarter, not the driver. That 3% organic growth was largely thanks to La Mer and Estée Lauder.
Ah, helped by the travel retail bounce back.
Exactly, especially in Asia. The Ordinary also helped, drove some share gains with specific innovations, like a new acne treatment they launched. Shows new products still matter, but overall, yeah, just moderate growth in skincare.
Okay, so skincare held steady, fragrance flew. Where was the drag then? Which categories need a real turnaround effort?
That would be makeup and hair care. Makeup actually saw a 2% organic decline.
Ouch. What happened there?
Mainly Bobbi Brown, it seems. Lower shipments for new face products, and they strategically cut back on some eye color palettes. Also, some softness in Too Faced.
And hair care.
Hair care declined 7%, mostly driven by Aveda. They say this reflects sort of necessary strategic actions they're taking, like planned cuts to online promotions, exiting doors that aren't performing.
Right.
Plus, that softness in the salon channel is still a big issue for Aveda.
Okay, so summing up this deep dive, ELC basically promised a return to growth, and, well, they delivered it this quarter.
They did.
And the how seems to be this two-pronged approach, really leaning into digital channels, TikTok, Amazon, that Shopify partnership, and at the same time, executing this massive internal cost-cutting program, the PRGP.
Yeah, they made the internal changes needed to free up cash, and then they funnel that cash into the consumer-facing stuff they need for hopefully sustainable growth and getting those margins back up.
But there's always a but.
There is. The risk, I think, is that these really strong results in China and luxury fragrance might be kind of masking ongoing weaknesses, particularly in North America and in those legacy categories like makeup and hair care that are still struggling.
So the PRGP bought them time, maybe.
Exactly. It bought them time and resources. But fixing those underlying legacy channel and category issues, especially domestically, that's still the big job ahead.
And then there's the whole world outside their control, the macro environment that doesn't really care how well you've restructured internally, does it?
Not at all. Global economic volatility, geopolitical risks, those are huge external factors.
Right.
And that really sets up the core tension for ELC going forward. They are trying to mitigate some of it, operationally, taking steps to manage global trade policy uncertainty, optimizing manufacturing regionally, supply chain agility. They specifically mentioned using their Japan facility more.
Okay, practical steps.
But even with that, the company itself is forecasting that tariff-related headwinds are going to hit their fiscal 2026 profit by about $100 million.
Wow, a $100 million drag just from trade issues. An external hit they can't entirely avoid. So that really leaves us with the big question, doesn't it? Can the financial gains they're making from this aggressive internal clean up the PRGP savings, the digital growth, can that actually outrun the drag from things like global trade conflicts and tariffs?
That's the key question.
That tension, yeah, between what they can control internally and these big geopolitical external pressures. That feels like it's going to define ELC's story for the rest of this fiscal year.
Absolutely. Their internal fixes need to be powerful enough to push through those strong external headwinds.
Well, that seems like a good place to leave it. That's a wrap on this deep dive. Thanks for joining us.
Thanks.
We'll see you next time.